PDF Solutions beat Q2 2026 consensus estimates on both the top and bottom lines. EPS came in at 27 cents, beating the 26-cent estimate.
Why, a slight beat there.
Yeah, and revenue hit $61.5 million, which edged past that $61.17 million consensus. That's a 19% increase year over year.
And management immediately reaffirmed their target of 20% full-year 2026 revenue growth, too.
Which implies a target of around $262.8 million,
Make
right?
a hurry.
But the stock reaction was just, it was incredibly volatile. Shares dropped 7.2% to $45.90 during the regular session, rebounded just under 2% in after-hours trading, and ultimately settled around $49.45 with some wild intraday pops of over 7%.
Which tells you immediately that the market is struggling to price this asset. I mean, for a stock trading at a massive premium with a PE ratio hovering anywhere from like 195 to over 271 times trailing earnings.
That's a huge premium.
It really is. And a narrow beat just isn't always enough to satisfy institutional expectations at that level. When you're praised for perfection, the underlying metrics have to be completely flawless to sustain any real upward momentum.
So to figure out if PDF Solutions is the ultimate AI infrastructure play or just an overvalued hardware trap, our mission today is to look completely under the hood. We're taking a deep dive into their Q2 earnings report, the management call, and a whole stack of analyst notes.
Yeah, if you're holding this stock or even just watching the semiconductor sector, you really need to understand where this revenue is actually coming from.
Right, so let's look at that $61.5 million top line. Platform revenue was $49.1 million. That is up 14% year over year, but, and this is key, it is actually down 4% sequentially from Q1.
Right, the sequential drop.
Yeah. Meanwhile, volume-based revenue saw massive growth, coming in at $12.4 million. That's up 45% year over year and like 35% sequentially.
The first thing you really have to understand about those top-line numbers is just the stability of their overall revenue mix. Right now, 80% of their revenue is recurring, with only 20% coming from upfront recognized revenue.
Okay, so that massive volume-based surge we just mentioned.
Yeah, that was largely driven by two things, their game share program and Symmetrix runtime licenses.
Let's actually define what that means on the factory floor, because it's pretty crucial. Semiconductor fabs are some of the most expensive factories on Earth, costing upwards of $20 billion to build.
Insanely expensive, yeah.
Right. And if they manufacture a silicon wafer and a tiny microscopic defect ruins half the chips on that wafer, their profit margins just evaporate.
Completely.
So PDF Solutions provides the analytics to detect those errors early. And gain share is essentially a performance-based royalty model. Think of it like a toll booth on a newly paved highway.
I like that analogy.
PDF software helps the fab reduce errors, paving the road, so to speak. And in return, PDF takes a micropenny for every flawless microchip that rolls off that line. When global fab volumes go up, PDF's revenue goes up automatically.
Exactly. And, the Symmetrix runtime licenses function in a really similar way. Symmetrix is their software that allows the factory equipment to communicate with the central factory network.
The connectivity layer.
Yeah, so every time a connected machine runs a process, PDF gets a tiny cut. It is a highly scalable, high-margin revenue stream.
But, if I'm looking at this as an investor, I have to point out a potential red flag here.
Yeah.
You mentioned the 80% recurring revenue, which sounds great. But I can't ignore that 4% sequential drop in platform revenue from Q1 to Q2.
Sure, it jumps out at you.
Right. Like, if I'm evaluating a standard SaaS company and I see a sudden dip in enterprise platform revenue right before a major renewal cycle, I'm going to assume demand is quietly softening. Why shouldn't I assume the exact same thing here?
Because semiconductor capital expenditure cycles do not behave like standard enterprise SaaS subscriptions.
Okay, how so?
Well, a sequential dip in one quarter's platform revenue often just reflects the lumpiness of when certain manufacturing nodes are brought online, right? It's not necessarily a structural decline in demand. And honestly, the proof is in their backlog.
The backlog is the buffer. Yeah.
Exactly. The backlog serves as the ultimate buffer against quarter-to-quarter volatility. And their ending backlog hit $270.7 million.
Wow.
Yeah, that is up 10% sequentially and 16% year over year. That metric alone tells you that forward-looking demand remains highly robust across their entire global footprint.
And looking at the sources, that footprint is highly diversified. Currently, 55% of their revenue comes from the U.S., 14% from China, 11% from Japan, and 20% from the rest of the world.
It's a very healthy pipeline.
Unquestionably healthy. And here's the pivot. If this backlog is so massive and the demand is global, why isn't that translating to flawless profitability right now? Because when I look at the balance sheet, I'm seeing a very real margin squeeze,
Yeah, it's a tale of two margins, really. On the operating side, things look highly efficient. I mean, their non-GAAP operating margins improved to 22%.
which is solid.
Very solid. That demonstrates excellent cost control on their operating expenses, which only rose 5% despite all their ongoing investments. They are running a tight ship when it comes to standard overhead.
But the non-GAAP gross margin contracted. It dropped to 73%, down from 76% in Q1.
Yeah.
This is where I want to dig in. How does a company control operating costs so well while simultaneously losing ground on growth margins?
The gross margin squeeze is purely a product mix issue. It's driven by the physical reality of what they're actually selling.
Okay, break that down.
So the first quarter benefited heavily from high-margin perpetual software licenses. Software has essentially zero marginal cost to replicate. Once the code is written, selling another license is almost pure profit.
Right, you're just selling digital keys.
Exactly. Q2, however, lacked that high volume of perpetual software licenses and relied much more heavily on physical hardware components.
Specifically, their eProbe tools.
Right. And physical hardware inherently carries lower margins than pure software. I mean, you have to pay for the raw materials, the specialized computing elements, assembly, global shipping.
All the physical world constraints.
Exactly. So every time the revenue mix tilts away from software and toward hardware, you are inevitably going to see gross margins contract.
Which directly impacts their capital allocation strategy.
Yeah.
They are sitting on a very strong cash position right now, about $114.9 million, which was heavily bolstered by a recent follow-on equity offering. But they're burning through it. Capital expenditures hit $14.1 million in Q2. If they are valued by the market like a high-margin software business, why are they spending so heavily on physical infrastructure?
It basically comes down to data acquisition. To feed their advanced analytics software, they need hyper-accurate proprietary data from the factory floor.
And they can't just get that from the machines themselves.
Not anymore, no. Standard factory sensors often aren't good enough anymore, especially for these new complex AI chips. So PDF Solutions has to build and deploy their own physical diagnostic tools, the eProbes, to gather the data that their software relies on.
Ah, okay.
Yeah, that $14.1 million capex is tied entirely to building these systems and securing long-lead hardware items. And crucially, management signaled that capex will likely be even higher in Q3 and Q4 to support these deployments.
So the rise in capital intensity is like the necessary toll PDF must pay to capture the massive AI tailwind they are chasing. You literally cannot capture the specialized AI data without the physical probes monitoring the silicon.
Precisely. They have to subsidize the hardware deployment to fuel the high-margin software analytics later down the road.
And this ties directly into CEO John Kibarian's commentary. He stated on the call that the semiconductor industry is in the, quote, very early stages of AI transformation.
Yeah, and the strategic victories they logged this quarter certainly support that thesis.
Oh, absolutely. They landed the largest SecureWISE contract in company history. It was an 8-figure deal with an existing equipment vendor customer.
Let's clarify why SecureWISE is so critical right now. SecureWISE is a platform that allows the companies that build the fab equipment to securely connect to their machines while those machines are actively operating inside a customer's fab.
Right, because fabs are insanely secure.
Exactly. Semiconductor fabs are some of the most highly guarded, secretive facilities on the planet. They do not want outside vendors accessing their internal networks.
IP theft is a huge concern.
Exactly. But as these machines get more complex to handle AI chips, the vendors need to monitor them to prevent breakdowns. SecureWISE acts as a highly encrypted bridge, allowing remote diagnostics without breaching the fab's security protocols.
It's an incredibly sticky product. I look at this entire suite SecureWISE, eProbe, Direct Scan, Exensio, and it feels like PDF Solutions is building the central nervous system for semiconductor fabs.
The nervous system.
Yeah. Like as AI chips become astronomically complex, fabs are practically forced to pay for this analytics layer just to ensure their manufacturing yields don't collapse.
Central nervous system implies they're actively controlling the factory, which isn't quite right. It's probably more accurate to say they are building the factory's immune system.
Oh, immune system? I like that better.
Yeah, they're constantly hunting for anomalies, microscopic defects, and system failures before those issues multiply and kill the yield. And management made a fascinating point about that massive 8-figure SecureWise deal.
What was that?
They don't view that contract value as the ceiling. They view it as a minimum base to build upon with that specific customer.
Wow. They also noted major expansions for direct scan. And it's not just the bleeding edge 3-nanometer AI chips that need this.
Hmm.
They are seeing demand for direct scan in more mature process nodes as well.
That's right.
That is a massive data point because it significantly widens their total addressable market. It proves that the demand for better yield analytics isn't just an AI fad, it's a structural requirement across the entire semiconductor landscape.
It is a strong narrative for sure, but as an analyst, you have to separate the narrative from the execution.
Oh, wait.
The AI story they are pitching is pristine, but the reality of executing on that narrative exposes the company to severe operational bottlenecks. And this is exactly what the bear case is heavily focused on.
Right, let's talk about the bear case.
Yeah.
Because as you mentioned at the top of the deep dive, this stock is trading at nearly 200 times trailing earnings. It is priced for flawless execution. But if you look past the non-GAAP adjustments and look at their GAAP net margins, they are incredibly thin. We're talking about 3 to 4% GAAP net margins for the quarter.
Yeah.
When your margins are that thin, there is absolutely zero room for error.
None. And management actively flagged 3 specific operational risks on the call that threaten those exact margins. First, rising component costs.
Inflation.
Basically. The computing elements required for those physical eProbe systems are getting more expensive due to supply chain inflation for specialized electronics. That is going to continue pressuring those gross margins we talked about.
Right. And the second risk they highlighted is conversion risk on their direct scan units. And this is a fascinating dynamic to me. They deploy evaluation units of direct scan to customers. Essentially, they ship a massive, expensive piece of physical hardware to a fab for them to just test out.
Yep.
But it can take up to a year for those evaluation units to actually convert into contracted, recognized revenue.
Think of it like a high-stakes freemium model.
Okay, how so?
It's like offering a free 30-day trial for enterprise software, except in this case, the free trial requires building a $1 million piece of specialized hardware, shipping it across the globe, integrating it into a clean room, and then waiting 12 months to see if the customer actually signs the contract.
That is wild.
It really leaves near-term revenue timing highly uncertain.
Which brings us to the third risk, and frankly, the one I find the most alarming. Management admitted that their production expansion is currently being bottlenecked by supply chain timing rather than their own internal factory capacity.
Yeah, that's a tough spot.
They have the space and the people to build more tools, but they are waiting on highly specialized, long-lead components to arrive.
And that is a dangerous position to be in when you have a beta of 1.67.
Right. Let's anchor that metric for a second. A beta of 1.67 means this stock is strapped into a roller coaster that moves nearly twice as aggressively as the broader market. It is highly volatile. If global supply chains are dictating their growth pace rather than their own internal execution, doesn't that leave the stock incredibly vulnerable to broader macro shocks?
It leaves them entirely exposed. I mean, when you are carrying a multiple that rich, you do not have the luxury of blaming the supply chain on your next earnings call.
The market doesn't care.
The market doesn't care whose fault it is. If you are priced for perfection, any delay in converting that massive $270 million backlog into realized revenue will trigger aggressive sell-offs.
And that vulnerability is the exact mechanism behind the initial 7.2% post-earnings dip we saw.
Exactly. Institutional investors saw the massive backlog, which is great, but they also saw the supply chain bottlenecks, the rising CapEx requirements, and the margin compression.
They realized the path to actually recognizing that revenue is going to be messy, and they hesitated.
Yeah, they hit the sell button.
So if you are analyzing this earnings report, this leaves you with a final thought to ponder. The broader market continues to blindly assign premium software-like valuations to almost any company touching the AI boom.
Right.
But by doing that, are we severely underestimating the messy, capital-intensive, hardware-constrained reality of actually building the infrastructure for it?
It's a great question.
PDF Solutions sits perfectly at the collision point of high-margin software aspirations and low-margin hardware realities.
No.
The demand is undeniably there, but building the immune system for the AI revolution is going to be a lot more expensive and a lot slower than a simple software update.
Couldn't have said it better.
If you want to stay ahead of the market and cut through the noise, make sure to follow the show for our daily earnings coverage.